It takes a fraction of a second to spend money online. You tap a screen, a green checkmark flashes, and the cash leaves your account. But right now, paying $200 or $300 at once is a hurdle. Inflation has increased the cost of daily necessities, making large upfront purchases a strain on the average monthly budget. Buy now, pay later platforms have moved into physical shopping malls. Platforms like Klarna are advertised on retail doors before you even step inside. You can find Afterpay stickers at the Container Store, where shoppers use the service to finance storage bins and basic household organization. This system changes how the brain assesses cost. When an app like Affirm splits a $200 price tag into 4 $50 payments, the brain calculates affordability based on the smaller fraction. These platforms convert the immediate pressure of a large expense into a series of micro-obligations that feel manageable in the moment. For decades, borrowing money required centralized systems like the traditional credit card, with its formal application and structured terms. Buy now, pay later replaces that process with an instant app-based transaction. These services offer 0% interest and instant approval at the point of sale, bypassing the manual reviews required for a standard credit line. This creates a choice. Is this an interest-free way to optimize cash flow, or a fragmented debt trap hidden behind a convenient interface? Comparing these systems directly reveals the trade-offs and provides the framework necessary to manage these payments safely. This comparison matrix tracks how both systems function. It begins with the barrier to entry, the process of acquiring the power to purchase. Traditional credit cards require a hard credit check. Banks review your financial reliability before granting a credit line. Buy now, pay later platforms use automated approvals. They rely on a soft credit pull, or in some cases, no credit history at all. This provides immediate access to credit for people who may be excluded from the traditional banking system. However, this accessibility removes the standard financial checkpoints that usually prevent a consumer from taking on debt they cannot repay. The next row focuses on the cost of capital, the price you pay to borrow the money. Carrying a balance on a traditional card involves a 20 to 25% interest rate. This cost compounds monthly, keeping users in debt for years. The standard buy now, pay later model avoids interest charges. They provide the capital for free, provided the payments are made on time. The cost mechanism changes when a payment fails. Instead of interest, these platforms generate revenue through late fees that trigger the moment an automated withdrawal is declined. Missing these payments can also lead to reports to credit bureaus, which impacts your ability to secure loans or housing in the future. You are trading a predictable interest rate for the risk of punitive fees if your bank account balance ever drops below the required payment amount. The risk increases when these services are used for daily survival. As inflation persists, consumers are shifting from financing luxury items to financing basic necessities. Many are now financing perishable goods, taking on debt to pay for a standard week of groceries. Augments your debt visibility. Using Klarna for shoes, Affirm for groceries, and Afterpay for household items makes it difficult to track your total outstanding obligations. On this timeline, a single purchase split into 4 payments over 6 weeks appears easy to manage. But as you make a new purchase each week, the payments stack, creating a concentration of required cash in weeks 3 and 4. This concentration can exceed your weekly income. This stacking effect is invisible until an economic shock occurs. If your work hours are cut or an emergency expense arises during a peak payment week, the system defaults. A single cash shortage triggers a cascade of late fees across 4 different apps at the same time. A traditional credit card generates a single consolidated statement. Buy now, pay later obscures the total debt load by fragmenting it across multiple platforms. This decision tree provides a framework for using these tools safely. It starts by categorizing the purchase. Is it a necessity or a durable good? The necessity path is a high-risk zone. This includes items that are consumed immediately. Financing a tank of gas means you will likely burn the fuel weeks before the final payment is withdrawn from your account. Borrowing for this week's necessities ensures a cash flow deficit next week. This creates a cycle where you must borrow again just to cover the previous week's consumption. The safer path involves durable goods, items that outlast the loan. This requires having the full purchase price already in your bank account. If you have the cash, keep it in a high-yield savings account to earn interest while using 0% financing to pace payments. Used this way, the service is a tool for cash flow management. It is not a solution for a lack of actual purchasing power. To use these platforms responsibly, you must manually recreate the visibility lost by moving away from centralized credit. This requires a dedicated spreadsheet to track every active microloan. Open your payment apps now, add up the total outstanding liability across every platform to see the real cost of your deferred payments. Every shopping bag represents a financial decision that will impact your bank balance in the weeks to come. Buy now, pay later is not inherently evil, but convenience often masks financial vulnerability. Every payment deferred today is still money that must leave your pocket tomorrow.